I'm going to start that right now. Okay, cool. So let's get into it. What I started with yesterday, which I'm just going to kind of recap for the new people, is that for me personally, in the last kind of 33 months when I was going through my course, I was able to complete a lot of the courses pretty fast, and I was able to have a pretty good score rate as well. So course one, I was able to complete 5 days. Course four took me about 12 days. And overall, pretty good marks, I think around the 90s, 89, 92, 96. And since then, I was able to become a realtor since 2021, make the group, be able to tutor people one on one, almost 500 people now, which is amazing. We're coming up on a big number now. But all of this is just to say that I put in a lot of time into really getting to know the content, reading the content, really, really trying to understand it. And that's helped me to be able to kind of give it to you guys. So some of you guys, like I've tutored before, so I see you guys again, but it's helped me to kind of be a good teacher. Um, and all of this kind of just to wrap up and say that what I'm trying to teach you guys and what I'm going to show you guys today are stuff that actually works. So these are not kind of random things. These are stuff that I've done, I've tested before. And a lot of stuff that I'm going to be showing you guys today are literally the stuff that I use exactly in my sessions that I use to tutor people as well. So hopefully you guys are going to get some value out of it today. Um, from yesterday. So yesterday I kind of broke down the entire agenda. So what we looked at yesterday was how to pass on the first try, how to pass in 3 weeks or less, the entire offer process, so the APS. So we went through the APS. And today we're going to be going over the mortgage financing process and the condominium breakdown. Now, obviously we covered all these things. So those three things are covered yesterday. I'll give you guys a bit of a recap for these three things for the new people that weren't here. And then we're going to get into the mortgage financing process, and then we're going to get into the condominium breakdown. Okay. So a short recap from yesterday. To kind of sum up the entire hour we did yesterday, if you are trying to pass the course in a short amount of time and you really, really want to pass it with good marks on the first try, maybe in 2 weeks, maybe 3 weeks, 4 weeks, whatever it is, the fundamental is that you have to be able to identify what your issue is. You have to be able to make a plan, and you have to be able to take action immediately. Okay, meaning you got to be able to ask yourself the right kind of questions like, where are you right now in your studying? And be honest with yourself. And you have to be able to work backwards from there. Right. So a lot of people, a lot of times I see students who sometimes get stuck or aren't able to go forward. And it's usually because of their own barriers where they're not able to commit to studying every day, or they're not able to maybe understand the material. But you got to realize if there's something that you're not getting from the material, we know people have passed this course, so we know it's doable, meaning there's something that we can change to make it work. Okay. So a little bit of a recap. Some of the top performing students I have, they usually are highly motivated, highly practical, and they have healthy stress. So I talked about these yesterday in depth, but essentially people that are motivated by their passion for real estate often do better on the exam. And that's from my experience. So the more you can find a motivation for yourself and the more you can align it with maybe something like that you actually like to do instead of just the money wise, you're going to find that you're going to be more engaged while you study, and it's going to be a lot easier for you to do the exam. Now, they're highly practical. When I say highly practical, I'm talking about they're looking constantly for ways to increase their scores. And to give you guys a brief rundown, there's 3 ways you guys can do that. So be honest with yourself, change something, and always self-evaluate. So again, this is something we went through yesterday, but being honest means asking yourself a lot of the right questions. Where are you right now? Where do you want to be? How much time have you actually been putting in? How much time do you need to put in? Is what you're doing working? Is it not working? You got to be honest. Then you got to change something. And I say change something, not everything, because we got to be able to change one thing at a time to see if what we change worked. Okay, you got to do it like a scientist, right? Like if I change this one thing, maybe it's the questions, and suddenly my scores go up. Okay, that worked. If I just change the questions and have the same kind of score, then okay, it wasn't the questions. So you got to do this with your study methods. You also got to do this with the way that you're studying the material. If you're listening to it, maybe try looking at visuals. If you've looked at the slides, maybe try reading the notes. You got to experiment and self-evaluating. So you got to constantly ask yourself, are you in line with your goals? Okay. Kind of a last point to wrap it up. Um, Overachievers always win. So this is something I talked about yesterday, and it's something that essentially is something I notice with a lot of my top students. They're self-starters. I don't need to push them and poke them to kind of study. And most of the time they're doing above and beyond. Like I'll tell them, you just have to do 2 hours of study and they're going to do 3. I tell them you just got to do 10 questions, they're going to do 20. So naturally, the more work that you're going to put in and the more committed you are, your results are going to just come like that. You're not going to have to try too much. If you just put in the time and energy, even if you don't know what the heck you're doing, even if your scores are really low right now, just the fact that you can outwork other people, that's already going to get you to the top of the game, whether it's studying or whether it's real estate as well when you guys get your license. Okay. So those are some of the stuff that we covered. Today, we're going to go through these 2 things here: the mortgage financing process, the condominium breakdown. And then for the people that were not here with us yesterday, so you guys missed the class yesterday. So I already have a lot of free stuff available online for you guys. You guys can take a picture of this if you want. There's checklists for you guys. There's free quizzes for you guys, YouTube videos, notes. So the link is there for all of those things. But for those of you guys that want the recordings for yesterday and the recording for today, as long as you're on my email list, you will be getting the recording automatically. Okay, so 2 of the best ways to sign up for the email list is you sign up for the checklist or you sign up for the free quiz. And literally, it's just your email. I'm just going to send you the checklist or the quiz, and then I'll send you the recordings. That's literally it. Okay, so this is a little bit of an easier way if you guys want. You guys can kind of scan that QR code. Takes you directly there, put your email in, and then I'll be sending that about in like a day or so. Okay, so day 1, day 2, I'll send you guys both of the recordings. Okay, so are we all ready to start? Give me a yes in the chat. All ready to go? Okay, yeah? All right. Okay, let's get it started. Okay, so we're going to start off with the mortgage financing. Okay. Now, mortgage financing is a topic I picked because it's in every single course. It's a little bit less in C1, but C2, C3, C4, they talk about it a lot. And numbers is not always everybody's strong suit. So I'm going to break down the main concepts I think come up the most. Obviously, there's a lot I can go through in mortgage, but I'm going to try and give it to you guys as much value as I can in a short amount of time. Okay, so first thing, 2 types of mortgages. And this is all just based on the course content, and this should be applicable to every single course. We have legal mortgages and we have equitable mortgages. Okay, fancy names. Legal mortgage is your first mortgage. That's the first mortgage you get on a property. Super simple, that's the most common. Equitable mortgage is a fancy name for additional mortgages you get. A second mortgage, a third mortgage, etc. Okay. Now, naturally, if you're a lender, you have somebody asking you for money. If this is their first loan, you're going to say, you know what? Sure, like I have no reason to not believe you're not going to pay me back, so why not? If you come to me and you already have a loan, or maybe 2 loans, now I'm skeptical, right? You only make 50K a year, and you have 2 loans of $1 million each. Like if you're asking for a third loan, now I'm a lot more skeptical. Are you going to pay me back, or are you going to go bankrupt? So this is the issue with equitable mortgages. The more mortgages you get, the higher risk it is. And the higher risk it is, lenders are going to charge you interest. That's how they compensate. Or they might just not give it to you at all. But if they do give it to you, they're going to charge you high interest. Now, for these equitable mortgages and for these lenders that are going to charge you this higher interest, the main reason why they're going to be doing this is because the risk of bankruptcy for them is super big. And they might still give you the mortgage because they might be able to recover the value from selling your house, but it's not their plan A. That's like their plan C. Okay, so lenders that are going to be giving you this mortgage, they're looking at the fact that as a third lender, if you go bankrupt, you're going to have to pay your first lender first, then your second lender, then you're going to pay me. Which means if you go bankrupt, you might not even have any money left to pay me. That's why these mortgages become risky, and that's why it's really hard to get them. Okay. Now, to break down the market for both of these things, we have 2 types of markets for mortgages. We have a primary market and we have a secondary market. The primary market is what you guys are most familiar with, many of you guys. This is where you're a borrower, you're getting money from a lender, and the lender is going to qualify you either as a prime or a subprime mortgage. A prime mortgage is a really, really good mortgage. It means this person is very likely to pay you back. So, great credit score, great financial standing. Subprime mortgages are the opposite. These people are unlikely or more likely to go bankrupt or not pay me back. And so that is in a different category. Naturally, the people with prime mortgages get lower interest rates, and the people with subprime mortgages get higher interest rates. Okay, so that is the first market for mortgages. That's how people make money. The secondary market, this is for investors. So not really banks. This is where we're talking about private lenders. And private lenders can sell mortgages to each other, right? So if I'm a private lender and I have somebody that, I gave money to and they're paying me back monthly, halfway through the contract, I could be like, you know what? I want my money now. So I can sell this to another lender. I'll have to kind of pay them a little bit of money, but they'll give me almost all my money up front. And that person is going to continue paying that other lender. Okay. And this is kind of, these two things were big contributors to the financial crash that happened in like 08, 09. These were kind of big reasons for it. If you guys are familiar with that, you can look into that. It's really interesting. But investors privately selling, that is also a second market. Okay. Now, for your guys' course, there's a few terms you have to know. These get a bit confusing. So the easiest way is to try and rhyme them. So mortgager, easiest way to remember, it rhymes with borrower. Okay, meaning the mortgager is the person borrowing the money. The mortgagee is the person lending you the money. They're giving you the money. Amortization is the period over which you're paying off your mortgage, 20, 30 years maybe. And different ways to pay it back. You can pay it monthly. You can pay only your interest, only your principal. Different ways to do that. And then loan to value ratio, LTV. This is the loan divided by the value of the property. So for example, if I have a property that's value is, let's say, $1 million, this is the value of the house, and I have a loan that I took to buy this house, and that was 600K. My LTV becomes 60%, right? Super easy. It just means 60% of the value of the house was financed with somebody else's money. That's a loan. That's some debt I have. Okay. Now, the problem with LTV is lenders will look at this and be like, okay, the higher LTV, just looking at the number, even if I didn't look at this, I know the higher this is, the higher your loan was. And the higher your loan is for a lender means risk, means you might go bankrupt. So high LTV is not good for lenders, and they're going to charge you more interest for that. Okay. I think they like to keep this around like 30, 40%, generally, I think. Anything like past 60 or 70 becomes like, they're going to either charge you insane amounts of interest, or they might not even give you the mortgage. Okay. But it's just a ratio so they can see how much debt you actually have on this property. Okay. And then I'm going to break down two other things here. So many of you guys who are already kind of into the mortgage stuff, you might already know this. But if I'm taking, like, let's say this mortgage for 800K. There we go, 800K. This is my mortgage that I want to borrow. This is the money I'm asking for. The lender is going to say, okay, your principal, which is the money you're going to pay me back after 20 years, is the 800K. But I'm not giving you the money for free. So I'm also going to charge you my fee, which is the interest, which is like, nowadays, I don't know, like 5%. Right? So if I do this quick calculation, let's see, like 5% on 800K, this comes out to about 840 in total, meaning over the amortization period. And in most cases, like I said, it's going to be 20, 30 years. So let's say 20 years in this case. Over the 20 years, I'm going to be paying back 840 in total, which is a combination of the principal and the interest. Okay. Now this is going to help you when you go deeper into the course because there's different repayment options. Most people, 95% of people, take this number, divide it over 20 years, and pay it in monthly installments, equal monthly installments. Okay, so for example, I would take this 840, I divide it by 20 years, divide it by 12 months, and now I get a monthly payment, which is 3,500 per month. This is my monthly payment. I pay this for the next 20 years, and that's my mortgage. Most people do this because the fact that you're giving the lender money every single month means they're happy and they're going to give you a low interest. Okay. Different options though, and you'll see this in the course. It's a lot to go into right now, but you'll see in the course there's stuff where they go into you can just pay your principal and pay the interest after like 5 years. So maybe every 5 years you pay the interest. You can do the opposite. Maybe I only pay a couple $100s a month, so just the interest, and then I pay the principal every like 5 years. Okay, and the reason I'm keep coining the term every 5 years because amortization is the entire period over which you're going to pay off the mortgage, but we have something called a term, and a term usually is like a checkup, which could be every 1 to 5 years. So we'll say 5 years, which is like the lender's going to check in on your financial situation, the economic situation, and they can adjust your interest rate in some cases, and they can address some of the stuff that you guys agree to. So some of the options to repay your mortgage will allow you to maybe just pay interest monthly, and then after 5 years, you're just going to pay whatever you owed for the previous 5 years. So for example, maybe I'm paying like the 5% interest a month, which will probably be like, I don't know, 200 a month. And then after 5 years, I'm going to pay the accumulation of what I should have owed them, which, you take 800 divided by, 5 years. That's probably going to be about like 200. So you're going to pay this every month. And then when 5 years finishes, you pay this all at once. Of course, this kind of option is going to charge you a lot more interest. So it's not going to be this low. It's going to be like 800 or something. Like they're going to charge you like 10% interest or something because they're not getting that much money every month. So they want to compensate for the risk. Okay. So a lot of different options, interest only, principal only. So definitely look into those. All right.